This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I wanted to give you a portfolio update on my Sharesies public portfolio for the month of September, and I also wanted to talk about Stagflation, about a recent article that was published by a Bank of America analyst stating that stagflation is here. I wanted to talk about why the market's so worried about stagflation, what it is, and how you could potentially position your portfolio to do well if stagflation happens or even if it doesn't. So if you enjoyed today's video, be sure to hit like and subscribe. And as always, none of this is financial advice, not a recommendation for you to buy, hold, or sell any of the stocks that I have in my Sharesies public portfolio. So without further ado, let's get right into the video. So over here is my Sharesies public portfolio. As you can see, the portfolio value is $22,575 with a simple return of 26.38%. So this is as at the market close 1st of October, whereas later on, as you'll see in my spreadsheet that I have, those values will be as at the end of 30th of September. So that's the proper month and date. But I'm recording this on a Sunday, so here are the numbers. As you can see, Sharesies added a new feature where if you click on total return, it breaks down the different components of your return. And I find this very helpful because it shows you how much you spent on transaction fees so far. So far I've spent $147, which compared to the total return of $5,100, I think that's pretty reasonable. And in terms of the dividends, this portfolio has generated $450.92. So this is a dividend portfolio after all. So it's definitely good to see the dividends starting to compound over time. Now, in terms of the stocks that I have in the portfolio, nothing much has really changed. I've only added some more money into positions that I've already had in the portfolio, and these are Auckland International Airport, Collins Foods Limited, Heartland Group Holdings, Infratil, Kogan, Macquarie Group Limited, Oceania Healthcare, as well as Centre Group. So now let's take a look at the Excel spreadsheet that I prepare monthly. As you can see over here, I have fully allocated my cash in the portfolio, so I'm totally out of cash, and I've invested more money into Centre Group this month. As you can see, the allocation has increased by 1.6% month on month, and as well as the stock returns have increased by 4%. So currently sitting on a gain of 16.92%. Oceania Healthcare has dropped slightly because the share price has declined slightly from last month. It was at $1.57 per share, now it's at $1.48. So I've added more shares during the dip. Heartland Group Holdings makes up that 16.4% of the portfolio. So in the top three positions in the portfolio makes up around 60% of the portfolio. So it's a fairly concentrated portfolio, and these are in the retirement and aged care industry, real estate, as well as banking. The fourth largest position is Infratil. Kogan has been mainly flat. Auckland International Airport, the share price has rallied as well, so that's a gain of 0.4% in terms of allocation, and Collins Food up 0.6%. Macquarie has rallied as well to $182 as at the end of September from $166 last month. So overall, the portfolio has delivered a return of 26.91%, and that's an increase from 26.12% over the past month. So overall, the portfolio has fared pretty well considering that the global markets, especially in the US, has dropped quite a bit in September. So as you can see over here, the stock market had its worst September in a decade. The Dow Jones Industrial Average fell 3.5%, the S&P 500 down 3.9%, and the Nasdaq has been hit the most at 4.6%. All three indices had their worst September performance since 2021 when the European debt crisis roiled markets. There's a few factors that are contributing to the weakness in the market. Obviously, there is the China Evergrande situation. I've talked about Evergrande in my previous video over here, so you can check that out. Another factor contributing to the weakness in the market has been US companies revising their earnings estimates downwards because of supply chain constraints. Bond yields also rose, which puts a large dent into valuations of technology companies. So as you can see, the Nasdaq dropped the most at 4.6% compared to the Dow Jones Industrial Average as well as the S&P 500, because the Nasdaq is a tech composite. So tech stocks got hit harder because they obviously trade on much higher valuations, and as interest rates rise, that acts as gravity on valuations, and companies that have higher valuations tend to drop more when interest rates rise because their cash flows are derived further into the future, and when it's generated further into the future, you have to discount that at a higher rate because your discount rate compounds over time. So when your discount rate increase, that increase also compounds over time. So the further you generate your cash flows, the harder the valuations will get hit when interest rates rise. So that's caused the market to perform quite poorly in September. Now let's talk about stagflation, because that's come up in the news quite a bit now. So in case you don't know what stagflation is characterized by slow economic growth and relatively high unemployment or economic stagnation, which is at the same time accompanied by rising prices, i.e. inflation. So stagnation and inflation, you get stagflation, right? So stagflation can be alternatively defined as a period of inflation combined with a decline in the GDP. Stagflation was first recognized during the 1970s, where many developed economies experienced rapid inflation and high unemployment as a result of an oil shock. So an oil shock has caused the cost of goods to go up, because oil is a major input cost for a lot of goods and services in the economy. The reason why the market is so fearful of stagflation is because stock markets tend to perform poorly, as we've seen historically. The Dow Jones Industrial Average, which was just above 800 at the start of the 1970s, had only advanced to about 839 by the end of the decade, an overall gain of 5% over a 10-year period. So if we enter into a period of stagflation, history tells us stocks will perform poorly. So to summarize the two things that cause stagflation, the first one is supply side inflation, and that is usually as a result of an oil shock. And the second thing is falling GDP. GDP is defined as consumer spending plus investment plus government spending plus net exports. So if we start to see these numbers fall, then we should see falling GDP, and that will be a sign of stagflation. So the Bank of America analysts had said stagflation is here following months of rising prices. So the backdrop is that for months, prices have been rising as the US economy recovered from the pandemic, while financial markets have stayed priced for perfection, and central banks have clung to the view that elevated inflation would likely subside in short order. So all around the world, the central banks have been saying that inflation is just transitory because of the supply side constraints, as well as the pent-up demand causing transitory inflation. And once that fixes itself over time and supply and demand reaches equilibrium, then we should see inflation coming back to normal levels. But now, fears about higher prices are coming to the fore, with Bank of America analysts declaring on a Friday note that stagflation is here, and a government report showing US inflation is still at a 30-year high as of August. Even central bankers appear to be starting to capitulate this week, with Fed Reserve Chairman Jerome Powell saying that high inflation could run into 2022. This is the first week that markets realized that global growth could be weak and inflation more persistent. Bank of America global head of 10G FX strategy said energy price increases were a wake-up call for markets, and the scenario that's now more likely to develop is one in which we get higher inflation and weaker output. So remember, stagflation is higher inflation and falling GDP, or in other words, weaker output. He sees the prospect of more pronounced financial market moves in 2022 than those of the past week. His view is that stagflation is unfolding worldwide, but becoming more severe in the US, which could prompt policymakers to tighten monetary policy more aggressively than expected. So it appears that the catalyst for stagflation appears to be playing out. As you can see over here, Brent oil prices have been increasing since the lockdown, and even since it went negative during the initial stages of the Rona. And you can see that the producer price index by industry, in particular the general freight trucking and long distance truckload, has increased since the Rona as well. As expected, as oil prices go up, that's a direct cost to the business. Another cost of input as well is higher labor costs. As you know, with the Rona, that had led to a shortage in high-skilled labor, especially in New Zealand, for example, where we import a lot of our high-skilled labor. With the borders now shut, we can't get high-skilled labor, so that had caused a bidding war for high-skilled labor, and that has also caused cost push inflation. So these are the supply side constraints causing cost push inflation and higher prices overall. So that's the first part of the equation for stagflation. The second part is falling GDP. Now, a lot of economists out there have been reducing their GDP forecast and economic outlook, citing variance as top risk. So a panel of 47 professional forecasters have become more tempered about 2021 as a whole. Its median real GDP growth estimate for 2021 is down sharply at 5.6% compared to the 6.7% forecasted in the May 2021 survey. So now we can see GDP forecasts are falling, and with companies now revising their earnings guidance downwards because of supply side constraints, that could also be an indicator that GDP is likely to fall in the future. So that's the thesis for a potential period where we experience stagflation. Now, counters to stagflation are that if pent-up demand continues to boost the economy and consumer spend sustains, and business sees consumer demand continuing, and that drives investment. And when businesses drive more investment, they also hire more people, and that increases the labor force participation rate, as well as that supply chain issues dissipate as businesses invest more in the supply chain, and the supply side inflation eases because of that, right? So over time, as for example, if oil prices keep going up, then more producers will come into the market, add more supply, and that should see supply side constraints ease a little bit. So if this scenario plays out, then we might not see a period of stagflation as the economists are now forecasting. Now let's talk about how you can position your portfolio with or without stagflation happening. So I think these are the key factors to look out for. So during times of inflation and rising rates, you want to focus on businesses that have low capex, high pricing power, long duration fixed rate debt, as well as high cash flow generation and less speculative stocks. When you have lower capex, you don't have to spend more money now to invest in capex, and higher pricing power means you can pass on the cost of inflation down to your customers. Long duration fixed rate debt benefits because you're locking in a lower interest rate now compared to the current situation where interest rates have been going up. With rising rates means that high PE stocks tend to get hit more, and stocks that have stable or high cash flow generation tend to do well. These are not the only things to look out for, because stagflation also has reducing GDP growth. So in times of falling GDP, you want to look out for companies that supply goods or services with inelastic demand, which means that these products don't have substitutes or very little competition. So for example, stocks in the healthcare industry, utilities, and wide mode companies as well. So whether or not stagflation plays out or not, I believe that most of these characteristics will allow a stock to perform well even without stagflation. So stocks with low capex, high pricing power, and goods or services that have inelastic demand or high cash flow, less speculative stocks tend to do well, right? So in terms of my private portfolio, what I've done is I've reduced my position in Fiverr, which is a more speculative stock, which is a hyper growth stock and trades at high valuations. I've reduced about 20% of that position and moved that into Facebook, which is a stock that trades on undemanding valuations at the moment and generates high free cash flows. So I expect a company like Facebook to perform better than a company like Fiverr during times of stagflation. In terms of my Sharesies public portfolio, I haven't made much changes, and the reason being is that I believe the top 3 positions in my portfolio have some sort of characteristics that align with what I have over here. So for example, my largest position, which is Oceania Healthcare, it's also the largest position in my private portfolio as well. This is a retirement village and aged care operator which operates in the healthcare industry. They provide care for elderlies that need assistance in their day-to-day living. So these elderlies tend to have inelastic demand for their services, because if you need help, you will move into these villages. So they should do well during times of falling GDP because of inelastic demand. So the second company, Center Group, is a shopping mall REIT which have CPI clauses built into their contracts. So if inflation runs high and CPI numbers go up, then they'll be able to increase their rental prices as well according to CPI. So there's some protection over there from inflation. And my third largest position is Heartland Group Holdings, which is a bank which should benefit from rising rates as they expand their net interest margins. So these 3 largest companies, which make up about 60% of the public portfolio, have some sort of characteristics that I think should enable it to do well during times of stagflation. Now, there's no guarantee that stagflation today will play out the same as stagflation in the 1970s, so we're not really sure what will happen to stocks. The reason why I say that is because stagflation in the 1970s was caused by a spike in oil prices. The reason why this might not be the case now is because our energy sources are much more diversified towards renewables. So a spike in oil prices might not necessarily stay for very long as it did in the 1970s. So that's why I'm always a bit cautious in that, stagflation might play out, it might not play out, but these are the characteristics that I'm looking out for, and these characteristics will enable stocks to do well even if stagflation doesn't happen. So that's my perspective on the entire situation. So that's all for today's video. If you enjoyed it, be sure to hit like and subscribe. Leave a comment down below as well what you're doing to position yourself from stagflation, or if you don't think stagflation will come. Let me know what you think. Always keen to hear your thoughts. Thank you guys for watching. Until next time, take care.